Thank you so much all for joining. This is Prashant Kumar from Cashflow Champs. I am a certified commercial investment member, CCIM, and today's topic is cost segregation for multifamily syndication. Here at Cashflow Champs, we are helping investors gain financial freedom through passive investments in real estate. So just a disclaimer, I'm not an attorney or a financial advisor or tax advisor or an accountant, etc. The purpose of this webinar is only informational only. Please seek professional advice from appropriate personnel if you need deeper information. Just a little bit about myself. I'm married, I have 2 kids. I live here in Long Island. I'm managing partner in Cashflow Champs. I have worked with multinational companies for over 25 years in IT as a consultant. Our team portfolio is about 1,650 doors, $150 million, $146 million. I'm a co-host on a Cashflow Champs real estate podcast. I personally have had about 2,000 units in my portfolio in past, and of which I have about 1,000 of them still in my portfolio. I love helping others. I meditate regularly. I love multifamily, and in addition to multifamily, I love assisted living space also. If you want to connect with us, feel free to schedule a call with us. The first QR code on the left. We do multifamily underwriting sessions every Saturday free of charge for so many years. We have been doing it. That's the middle QR code. Feel free to take the picture of this slide. And we have an inner circle where we are helping investors to become active investors and become general partners in the deal. And we almost guarantee that, you will become a general partner within a short period of time, or we will continue to hold your hands for as long as it takes. Okay, so if you want to know a little bit more about that, please scan the QR code on the right-hand side. Today, we are going to talk about straight line depreciation, accelerated depreciation, bonus depreciation. And again, I'm not representing any company, but we do know many companies who do. If any referrals are needed, we can do that. We don't get paid or anything on that. But I want to bring the awareness about, how accelerated depreciation can help us in our journey in real estate. So let's start with straight line depreciation, what it really means. So in straight line depreciation, if you are buying an asset, which is, let's say, for example, $1 million, you have, the building, which is approximately 80%, land is not depreciable. If your building is about 80% of the value, which is about 800,000, you depreciate that over 27.5 years. If you are depreciating 800,000 over 27.5 years, you are getting the depreciation benefit as an owner of about $29,000 depreciation per year. So it is a straight line depreciation. There is no major math involved in it. 20% of 1 million, which is the building, approximately 800,000, you depreciate it over 27.5 years, which is about $29,000 per year, right? So that is a straight line depreciation. But as we go in accelerated depreciation or bonus depreciation, if you, in the same example, if you're, $1 million property, you have land valuation, we allocate about 20%. But for the building, 50% of the building, but 10% could be your land improvement, and 20% could be your personal property. So land improvement and personal property, basically sidewalks, anything you have done to improve the land, plus the personal property inside the building, some of that can be combined together, right? So 10% and 20%, about 30%. So 30% approximately, land improvements and personal property, if combined together, which is about 300,000, that can be depreciated. And if you are in a 40% tax bracket, you are talking about $120,000 saving. So a couple of years ago, when Trump came, we had Jobs Act. In that, you can take full bonus depreciation in year one. So you had approximately 30% of the value of the asset can be depreciated in year one. Although this Jobs Act bonus depreciation is fizzling out after 2022, in year 2022, we could take 100% of that 30%, which is 120K. But going forward, I think there is still talks going on, but at least we will have 80% of that available to us right away, and the remaining 20% in following year, basically. So that 120,000, even in 2023, 80% of that is about 96,000 that can be depreciated in 2023, and remaining 20%, which is 24,000, can be depreciated in year 2024. This has been a great benefit where this depreciation brings the money in our pocket, has been putting the money in our pocket sooner than later. So I mean, as I said, in a straight line depreciation, you could depreciate only $29,000 per year, but in a accelerated depreciation, you would depreciate 30% upfront, and the remaining 50%, the building value, remaining 50% over certain duration, right? So that is done. That 30% upfront gives a lot of benefit to real estate investors. They are able to put a lot of money in their pockets. That's the primary advantage of bonus depreciation. So how does it work in syndication model, right? We talked about single ownership, right? But let's say we are talking about bigger project where we have 100 units, which is a $10 million project. Same kind of figures, just trying to keep it simple so that folks understand. If we have 100 units and we have $10 million purchase price, again, the land is 20%, which is non-depreciable. Building is 50%. Land improvement and personal property combined together is approximately 30%, meaning 30% of that 10 million can be the bonus depreciation. Up to year 2022, it was 100%, could have been taken from day one, but just consider that we can take the whole thing. If we are 10 investors in that deal, basically each get $300K depreciation. That's a lot of money. If you have a $10 million project and you raised, let's say, $3 million for that project to buy, and you were able to write off the whole thing, everybody got $300,000 depreciation. It's almost like they have written off the investments. So they reduce their income by almost 100% depreciation. So again, this is just an example. Let's talk a little bit more. So what really happens, in the syndication scenario, right? We create the categories, right? We divide the property into different categories, and in bigger projects like $10 million project or $20 million project or $50 million project, what happens is we create an analysis is done, right? And property is divided into different categories: 5-year category, 7-year category, and 15-year category, right? So some of the things like carpets, um, you know, um, they don't go for 27.5 years. The life cycle for the carpet is approximately 5 years. Other things go into 7-year category, and some goes into 15-year category. It's hardly that roof lasts for 30 years. They probably go in 15-year category. So they are allocated in different buckets, and then that is brought back upfront. So all that 5-year category, 7-year category, and 15-year category, personal property and land improvement, they are brought upfront. We are front loading uh, due to bonus depreciation. So in general, that front loading is about 30% of the overall value of the asset. So to my previous example, here we made it very simple, straight 30%. But in general, when all this is done, about 30% of the asset is depreciable upfront. That is called front loading of due to bonus depreciation. So for bigger projects, that 30% actually is approximately equal to the investments, and in some cases take care of the closing cost and stuff. So 30% of the property is depreciable in year one, meaning that almost all the investments can be depreciated. I mean, again, every property is different, depends on properties making income or not. In the new construction world, it doesn't work exactly that same way, because new construction takes some time, and it's only when the property is operational, that's when this depreciation can be applied in the year. So if you buy a hotel and it is an empty hotel and there is no leases in the property, basically for that year you cannot have bonus depreciation. The bonus depreciation will start when you start using the property, when you start have revenue coming into that property. So multifamily, I mean, we are multifamily guys, we do mostly multifamily, but for single family guys also, bonus depreciation is available. You can, if you have bought a single family home and you have been depreciating it on 27.5-year schedule, you can go back and update. You can, there's no need to amend your tax returns. Basically, even though you have been depreciating it over 27.5 years and you realize that you can do the bonus depreciation, you want to do bonus depreciation this year, you can do a form 3115. What it does is, yeah, so far you are doing straight line, but you want to do bonus depreciation now. So in the current year tax return, you do the bonus depreciation to take the advantage of that. Obviously, single family cost segregation study doesn't cost that much, and it is always beneficial for a lot of single family investors who are in the single family world, and they don't know that cost segregation can be done. It can be done in single families also, and the year in which, and you don't have to go back and update the tax returns for previous years. You can have straight line in previous years, and current year you can just do the bonus depreciation. You do the study, it is cheaper, and you get the benefit of bonus depreciation in single family. So you can offset your previous rentals basically. There are other scenarios like short-term rentals. Short-term rentals, you can do the cost segregation there. In folks, basically those who are busy professionals, their spouses can manage the assets, and they can go into short-term rentals. They can get the cost segregation benefit. So there is a component called real estate professional. For you to be able to write all the depreciation, you should be a real estate professional. So the point where I'm saying that a spouse can manage your asset, if you are a busy professional, but your spouse can qualify for a real estate professional, then you get the benefit of depreciation right there. Or you go in short-term rentals where even if you are not real estate professional, you get the benefit of cost segregation. So fundamental benefit of cost segregation is that you are getting the benefit right now. You are not avoiding the taxes, you are just delaying it. So your dollar today is more than dollar tomorrow. So wouldn't it be prudent for you to get that benefit today and then apply that benefit and use that money to do other cash flow activities in your business? So guys, once again, try to put some questions and answers, questions in the chat, in the Q&A box, and I'll try to take some, I'll try to answer them. And I have one question here. Yeah, so yeah, Ria is asking, just for clarity, depreciation is favorable because there are tax benefits involved. The depreciated value is taken out of the taxable amount of the property and returned to the investors. So yes, depreciable value is taken out of the taxable amount. It's not, no. So basically you get, no, that's not, that second statement is not correct, Ria. The way it happens is you don't get the money. It's just that you get the paper loss. So even if your capital account is 100,000, in terms of your income for, you would see a loss on your K1, and that loss can actually write off your active income or passive income, depending upon whether you are real estate professional or not. So so that's what it is, and I'll go a little bit into detail of that one. Let's see what next do we have. So basically, there are some pros and there are some cons of cost segregation. The con is it is costly. You have to spend some money to get the study done, and then that study is given to, and that is done by third-party companies. There are many third-party companies out there who do that study. For single family, obviously, it will not cost that much, maybe $2,000 or something. But for multifamily, it may cost as much as $7,000, $8,000, $10,000, right? Depending upon the size of the property. So any depreciation that you are taking, I mean, from a property accounting standpoint, you get the depreciation. Now it's up to your CPA or whether you are a real estate professional or not, whether you are able to take it in previous years or not. Once, if you have taken it, at the time of when the property is sold, that depreciation gets recaptured. So initially, let's say your tax bracket was 40%, but that recapture rate is only 25%. There's a benefit there also. So you are able to use all that money. Basically, let's say you got the depreciation of 100,000, you are a real estate professional, and you had W2 income of 100,000, you write it off, so you didn't pay taxes at all for that year. You use that money over a couple of years, but when the property was sold, that depreciation that you have taken will be recaptured, but it will be recaptured at a lower tax rate. Hopefully, it is better than what your current tax rate is 25%. The other thing is only real estate professionals can write off the whole amount. But even if you are not a real estate professional, you can, you have the limit of about 20,000, I think. This passive income can offset only up to $20,000 of active income. Remaining depreciation sits and you can continue to take that over years. So 100,000 came in, you are not a real estate professional, but out of that 100,000, you can take $20,000 per year over the next 5 years. So that is effectively reducing your income over a couple of years. You're not avoiding taxes, as I said. It's a wealth building strategy. You are deferring it for future. And the year 5 that will be sold, you will recapture it at a lower tax rate. Hopefully, if your original tax bracket was 40%, now you're going to recapture it maximum at 25 or at your current rate, basically. So with the cost segregation, you get the money now, basically. You are getting, the moment you are investing in that year itself, you are getting the depreciation as long as property is functioning. There's revenue generation happening on the property. So for real estate professionals, the tax write-off is unlimited. I mean, real estate professionals can write off everything in year 1. But again, that's fizzling out. It is not 100%. In 2023, it is 80%. It used to be 100%. So it gives a lot of boost to your cash flow. For year 1, you invested 100,000, you wrote off 80,000. You paid taxes only on 20,000 of your W-2. You have boosted your cash flow, basically. So it's one of the best tax strategies, basically. In short, bonus depreciation, cost segregation is the best tax strategy. I'm not a tax advisor, accountant, but I have used it, and that's why, folks who do real estate and they become real estate professional, they keep on deferring their taxes for unlimited time, and they have the cash flow. And even if they sell a property, they buy another one, then 1031 comes in, and things like that. I mean, these are not tax loopholes. These are IRS guidelines. IRS wants you to do that because they want the economy to grow. So it is nothing that it is a loophole. It's a tax strategy for real estate, those who are in real estate. And once you are in real estate, you can grow and take the compounding effect of that strategy, that tax that you saved. So in my earlier example, you invested 100,000, your W-2 is 100,000, and you got the depreciation of 100,000. You wrote off 100,000 from your, so you did not pay, effectively you did not pay taxes on your W-2, which could be 35%. You use that 35,000 for, you reinvested that, and you are continuing to make money on that every year. So you are getting the cash flow, you are deferring your taxes. When that property is sold, you recapture that at a lower percentage, but then you buy another property again, right? So you get depreciation there. So you are creating a compounding effect. It's a best wealth building strategy. That's all I wanted to communicate. Hopefully everybody is getting a hang of it. Let me see what are the questions and answers we have. So we answered Ria's question. The next one from Chutima. I understand that we LPs don't pay taxes in few years, even though we receive distributions. However, what happens when building is sold? So yes, when building is sold, as I answered, that the depreciation is recaptured, and basically at that time you have the tax liability. The depreciation recapture happens at a lower rate, or your rate at that time, depending upon your financial situation. But at that time you have the capital gain taxes. So you are deferring, you are not avoiding, you are deferring the taxes. But at that time, you have the option to do 1031. You can go to other deals, or I mean, not even 1031. If you just buy another asset and invest in another asset, there also you will get cost segregation. So we'll write off some of that at that time. The next is, what cost segregation firms do you use? I mean, we have used Cost Segregation Authority, typically, I mean, we use engineering services, ETS, and there are many more out there. Are they all the same? They're mostly the same. It depends, who works with you best. But I mean, in theory, everybody should be same. It depends on the geography. If you are on West Coast, Idaho, Utah, you would use Cost Segregation Authority, because obviously they have to come and do the study. If you are in New York, you would use somebody who has local presence to keep the cost low, right? It's only the travel expenses, but other than that, I think it should be same. I have not heard negative or positive in comparison to others. So Luke is asking, when would you prefer to use straight line depreciation versus accelerated depreciation? Seems like you want to accelerate more often than not to get the dollar in your pocket faster. Very clever question, and you already gave the answer, Luke. Is in real estate world, you want to use accelerated depreciation because it puts the dollar in your pocket now, right? Dollar today in my pocket is more valuable than dollar tomorrow, because once I have done it, I reduce my taxes, I have this dollar, and I invest that dollar at 10 in other assets, basically get another 10 to 15% return on that. So you are trying to get money now, and you are continuing to reinvest it, and that's the strategy that we have in real estate. I mean, why would I do straight line when I can do accelerated depreciation? So for year 2022, can I file an extension to the cost seg bonus depreciation for my STR? Yeah, for short term, for short term, you should do it. I mean, I don't think, I don't think it can be done so fast in the next 2 weeks or so, but you should file an extension, do a cost seg or bonus depreciation for your, even if you are not a real estate professional in STR, you should be able to get the bonus depreciation for 2022. Anonymous attendee asked that. And I think that's the strategy. That's why you invest in STR. Even if you are not a real estate professional, you have the ability to get bonus depreciation. So it should be done as long as it was producing revenue in 2022. So Sefwan is asking, can you explain with an example about tax recapture? So as I said earlier, you invested 100,000, your W2 is 100,000, and you got depreciation of 100,000. If you were a real estate professional, you would take that 100,000 right away in the same year. Let's say it was the year 2022. You took that, you did not pay taxes for that year, right? Now, after 5 years, when the property was sold, that 100,000 needs to be recaptured, but that would add you, that would add your income in your income, and then basically you will pay higher taxes for that year. But let's say you did not have any other income in that year, so your income is 100,000, but that the maximum recapture rate is 25% on that. Remaining, so you will end up paying about, whatever, 25% on the recapture portion. Remaining is the capital gains, basically. So again, depending upon your tax rate, the benefit, the appreciation will go at a different rate, and the recapture will be at 25%. Hopefully that answers your question, Sefwan. For lower tax brackets for AGI, less than 100K, would cost segregation bonus depreciation still benefit? Yes, because you are already delaying the payment, right? tax payment. Again, I'm not a tax advisor. Everybody's situation is different, but your tax bracket is one thing, but not paying taxes for the year is another thing, right? You are not paying the taxes for whatever number of years. You are delaying basically. So, and then you can reinvest that money back into other assets. So I'm not a real estate professional. I do have multifamily property and managing property and so on. Can this strategy benefit me? You are not a real estate professional. Would this benefit you? 100% it should benefit you, because you will be deferring your, even though you may not be able to write off everything in year one, but you are deferring depending upon how much is the valuation of the property. If it is $1 million property, maybe it will not benefit you that much, because doing the cost segregation will not benefit you that much, because for $1 million you have $30,000 depreciation. You are already maxed out. You can take only $20,000. But if it's a $500,000 property, and then basically cost depreciation allows you to get let's say $150,000 to depreciate, and then you should be able to depreciate that basically. We just have to look at the Excel spreadsheet, but it will definitely benefit you. Sean is asking, purchase, defer, exchange, repeat. They know the growing generational wealth. That's all it is, Sean. You said it correctly. You are continuing to buy real estate. You defer your taxes, and then you exchange. You do a 1031 exchange, or sell it and buy a new asset and continue to repeat it. And one thing I must tell you, those who are elder, I'm up there, but if sooner you start in your life, better it is. If you start it at 18 or 21, that's when you want to start in your journey in real estate, because in couple of years, the compounding effect is so much. From 21 to 30, if you have done 5-6 deals, you are already millionaire. You have gained that much. And I have models to prove that. And maybe I can talk to you separately if you have other questions around that. If you start sooner, means at the age of 21, by the age of 50, you have taken the advantage of this strategy years over years. It's invaluable in my mind, and it can be proven. We have models which we can put together to show how it can help us. All right, that's all I have. It's about 11:35. We want to keep it to 30 minutes of talking time. If you have any questions, please feel free to let me know. I would love to answer them. But in short, once again, if you want to talk to us, schedule a call with us. You have the QR code. We do the underwriting sessions every week. We underwrite properties. We help investors. And these are free, no obligation, every week, Saturday at 4 p.m. Eastern, middle QR code. And we are helping folks. We are looking for, aristocrats who are ready to start their career. And we have a smaller inner circle where we are almost guaranteeing that you will get into a deal if you are part of the inner circle as general partner. So if you want to know more about that, please feel free to scan the last QR code, and I will give my number if you want to text 631-428-6479, 631-428-6479. If you want to know more, just talk to me, text me and call me. In addition to that, and I should have mentioned it earlier, we have a cash flowing deal in Atlanta, 236 units, and I don't have the slide open right now for that, and maybe I can open a slide, and I apologize hopefully I'm not taking too much of everybody's time. I will open a slide in about a minute. What it is we have a property in Atlanta which we are closing in about 40 to 45 days from now, and that is cash flowing 8% year over year. So, and I will share that information in a very short format, not more than 2 minutes. Again, this is the property that we have, Park Valley Apartments Homes, 236 units. Again, this is not an investment webinar. I'm not giving an investment advice of any sort. This is our team, myself, Paul Senior, Charles Siemens. I talked about our background, but overall about the deal, it is a 8% cash on cash return, 17% annualized return, and 15% internal IRR, basically. So we have 7, 8, or 10% preferred return. The biggest thing about this deal is we are getting an attractive debt loan assumption at 3.48% for next 5 years, and that is 80% LTV of the project. So out of 32.3, we are getting 25.5 million at 3.48% fixed, and all, out of 236 units, 231 are already updated. So for us, it is a slam dunk deal. Anybody wants to know more about it, you will get this webinar back, but I just want to take 1 minute to tell you that there are deals out there where we are working on, so all it is for us is purchase and optimize operational efficiency, and our rents are about $200 below market. So if you look at it, you have average cash on cash of 8%. Somebody invests 100,000. Year 1, they get 6,000. Year 2, they get 9,000 on it. Year 3, they get 7,500. Year 4, they get 8,000. And year 5, 55,000. So total return is about, and it is a little bit older. 86.5, which is about 17.32%. And there's nothing to be done on the property. 231 out of 236 units are already upgraded. So I just wanted to share that. If anybody wants any information on this deal, I can share that. I can actually share this presentation in the chat window so that you have it. I have put this presentation, small presentation in this chat window. Feel free to copy that chat. And if there are any questions, please let us know. That's all I have, folks. Appreciate your time. Thank you so much for your time today.